today I'll be talking about this topic, right? So when you look at yields today, they're everywhere, right? You know, historically, when you look at the Aussie market, over the last decade or so, that was the only place to be. It was a no-brainer, right? Yields from Aussie equities just hands down beat term deposits over the last decade. It's only in the recent 12 months that we've seen term deposit rates skyrocket as the RBA raised rates. So today, when we look at term deposit rates at around 5%, well, why would you bother with Aussie equities from an income perspective? You know, like historically, Aussie equities is around 4 or 5%, but with what you would consider close to risk-free, 5% from a term deposit, that seems like a very viable choice in someone's portfolio. Now, I want to highlight three things in terms of the differences between equities, especially Aussie equities versus cash, right? So first of all, we can't forget imputation credits, right? So to compare apples to apples, right, we have to add imputation credits, right, on top of the income that you receive from Aussie equities, right? It is real money that retirees can spend, right? And roughly you add about 1.4% on top of the yield that you would receive from the market, from the Aussie market. Right now, term deposits are probably approaching around 5%, but there's still a premium that you can still receive from Aussie markets once you include franking. The other element, which most people don't really talk about much, we know that term deposits, right, the capital base is obviously rock solid. As long as the bank doesn't disappear, you're going to get your money back, right? So that is a guarantee, right? For equity markets, that capital base does move around, right? We have seen before in the past, let's say through the GFC and through market corrections, right, that capital base does move. But from an income perspective, it's actually very stable, right? So over the long term, the Australian market has provided just under 5% income return, right? It does vary a little bit. Sometimes when the market does go through, let's say the GFC, dividends do get cut, but it does, you know, drop to around 3%. So the variability isn't much. Sometimes the yield jumps to 6%, but it's roughly around that 4 to 5% mark. But the variability around term deposit rates is just enormous. Now, over the long term, it has been declining, and obviously in the most recent months, it's spiked up. But look at the range in terms of how wide term deposit rates are versus that long-term trend, right? You know, back in the late 80s, it was close to 16%, and obviously dropped dramatically when Australia had to have the recession it had to have. And you know, obviously it spiked prior to the global financial crisis, and then it collapsed again, right? And to highlight that feature further, right, if you think about the global financial crisis, you know, for the Aussie market and also for the term deposits, look, dividends were cut during that global financial crisis. And if you track the cash flows received from the Aussie market over that time frame during that global financial crisis, cash flows from Aussie equities fell at around 30%. To fend off a recession, the RBA had to cut rates. Right? It cut rates so aggressively that the cash flows from term deposits rates fell close to 50%. Right? So to totally rely on, let's say, cash on income, right now it looks very juicy, but historically we know it is not stable. Right? And obviously it's linked to the strength of the underlying economy. The final point I want to talk about in terms of comparing Aussie equities to cash is that, as you know, equities do provide growth over the long term, right? So for Australian equities, you're generally earning 4 to 5% on top of that growing capital base, right? And hence that's why it has this nice total return at the end, right? For term deposits, that capital base is rock solid. It's not going anywhere. It's not going up. It's not going down too, right? And all you're making is that investment income return, right? But what does this chart look like over the long term? So this is one of my favorite charts I've put together for clients. And what this shows you in the bottom end is, the bottom chart is the term deposit rate versus the income return for the Aussie market based on calendar year. The top chart tracks the amount of capital where you initially invest $10,000, right? And how that capital has tracked through time and how much cumulative income that was generated from that capital, right? Now, this chart is very similar to Vanguard. I think Vanguard has a chart where they show, index returns over the long term. But that's great if you're a 25-year-old or 35-year-old because you're reinvesting all the income. For a retiree, you're not. They're spending it. So this chart illustrates what it looks like if you're not reinvesting the income. Track the capital base and track the cumulative income. So let's go back in time to 1989, right? The worst point in history when you want to compare Aussie equity income versus term deposits. Back then, term deposit rates were 16%. Like, that is just a fantastic number. Like, imagine trying to wean clients off cash if that was 16% today. And in fact, back then, also Australia entered into a recession as well for a couple of years. Right? So dividends were cut. So that was the worst point in terms of thinking about comparing Aussie equities versus cash back then. And if you track that through time, it took 16 years for the cumulative income for Aussie equities to catch up to the cumulative income from term deposits, because term deposits had a very strong head start. But while you waited 16 years, the capital value for Aussie equities nearly tripled. Think about that, right? So because of that compounding machine, right? Over the long term, with the passage of time, right, equities do grow. Right? And as that capital base is growing, the 4-5% income return that you're generating off that growing capital base builds that income profile even further. Past that 16-year mark, the cumulative income for Aussie equities continue to grow, including the GFC that occurred in 2008. Right? So, and over that 35-year journey, the cumulative income that was generated from Aussie equities was nearly twice the amount from term deposits. Right? So over the long term, there's growth in capital that can actually grow that income base, which is obviously what cash can't offer today. But maybe, you might be thinking, well, today's at 5, maybe it can go up higher. I know we had a very strong CPI print yesterday, and, there are rumblings that the RBA could raise rates again. If they did, maybe the term deposit rates could be higher. So maybe, look, there's a chance for it to be higher or stable. There is some clues in terms of looking at financial markets in terms of determining whether that term deposit rate is actually sustainable or not. Right? So typically, an inverted yield curve precedes a falling cash rate. Right? So what do I mean by inverted yield curve? Basically, we're measuring the yield that's on offer on a long-term bond versus a yield on offer on a short-term bond. Right? If the long-term bond yield is lower than the short-term bond, basically the bond market is saying something is wrong. There's some sort of economic slowdown coming at some point because that short-term bond is held up by the current RBA rate, but the RBA doesn't control what long-term bonds do. Historically, whenever there's an inverted yield curve, it precedes these big cuts, right? Now, it doesn't tell you the exact month when they're going to happen, but generally that's the environment, right? So go back to the late 80s, early 90s, huge big cuts, right? In fact, Australia never had a recession in the year 2000, 2002, but the curve did invert a little bit, and that also preceded a cut. And of course, during the global financial crisis, again, officially Australia didn't have a recession, but there was huge cuts there too. Today, we can see the yield curve invert a little bit, right? Which is obviously the bond market saying that there's a potential slowdown coming, right? We just don't know exactly when, right? So to bank on the 5% rate for sustainably in the future, if you use history as a precedent, it's probably not a good starting point to say that 5% is going to last for another 3 or 4 years. How about high yield credit? So if you're not satisfied with a risk-free 5%, maybe high-yield credit could be a good place to generate further income for a client's portfolio. So this chart highlights the credit yield for a high-yield index from the US over the last 2 decades. And you can see, look, you don't see 9% yields too often, right? They do spike up, come down. But you also know when you're dealing in the world of high-yield credit, sometimes the high yields are there for a reason. Typically, something's blowing up, right? So I've now overlaid the US risk-free rate on the same chart, and you can see every time, typically, historically, when they spike up, something bad is happening within the corporate sector for the yields to spike while the risk-free rates are falling. Right now, when we see yields increase, it looks all good at the moment. The risk-free rate has risen quite a lot, but that spread hasn't blown out, right? So that begs the question, is this the new normal, right? So maybe high-yield credit is risk-free, if that is the case, if that's truly the underlying reason. There is another anomaly that you could see, especially from an equities point of view, right? We track, obviously, corporate profitability. And again, when you sort of switch our attention to the US market, right, we have seen historically when the Fed or central banks raise rates, typically you'll see interest rates rise and it'll slow down the economy, right? And that's a cycle that you can see, as clear as night following day. Right? When rate rises, interest payments go up, corporates cut back spending, corporates may lay off employees, and the economy slows again. Right? In this cycle, we have witnessed the fastest rate rise in history, but corporates aren't paying a lot for the interest payments. So it seems like a new nirvana. How good can this be? Another anomaly, right? So while corporates aren't feeling the bite associated with high rates, but the underlying economy is actually feeling a bit shaky, right? So historically, when you look at the experience in terms of bankruptcies in the US, they typically follow credit spikes, right? So it makes sense. When the economy is doing tough, credit spiking was because people can't pay their obligations, right? And that's why things are tough. In today's environment, we see credit spreads very tame, right? Credit yields been driven up by risk-free rates, but credit spreads have been very tame, right? While bankruptcies are rising. So again, does this seem right? Right? It feels like as if the credit market is telling you, why don't you come in and swim in the water? The water's nice and warm, right? It feels good. But underneath, the current is just churning, right? Something's happening underneath, right? So the bankruptcy profile is actually rising in the US while the credit market feels very tame. And the reason for these anomalies I'm just trying to highlight is that we have experienced a 1-in-100-year event 3 years ago, right? The COVID lockdowns, right, made everybody panic. Central banks panicked. They aggressively lowered rates to close to zero. They started, the US Federal Reserve started QE4, the fourth one post the GFC, to ensure the debt markets were liquid and stayed open, right? Corporates have never seen a lockdown before, so they panicked and go, look, we have debt obligations, we're just going to push as much of that debt refinance as far out into the future. By pushing the debt as far out into the future, you end up with this. You have a lot of debt refinancing coming. That's why over the last couple of years, the demand for credit, right, hasn't been high because you never have to roll over that debt because they pushed it out to 2025, right? So, there is an increased likelihood just purely based on supply and demand. So same reason why credit spreads were tame this year and last year, credit spreads will likely rise in the following year. corporates do not wait till 2025 to refi, right? They'll do it in 2024 because that's their job, right? Of course, if there's a recession, spreads will blow out even further. Now, I've talked about these anomalies from cash, high yield credit, but even equity markets. I think we're also at a crossroads. So this chart sort of highlights the percentage of down months measured over a certain time frame. Now, over the long term, we know equities are fantastic investments because 2/3 of the time it's rising, 1/3 of the time it's falling, right? But that's over the long term. But if you measure over a rolling 5-year period, it can actually vary quite a lot, right? So, and you can sort of see it. The percentage of down months actually fall quite a lot in very strong bull markets, leading up to the tech crash. The percentage dropped to 30%. Leading up to the global financial crisis, it went down to 25%. And more recently, we already had a very strong bull market, despite the fact that we had the COVID crisis in the middle, right? Leading up to 2022 was very bullish. In fact, it was on par with the GFC, right? Over the last year, we've seen the market, the equity markets, obviously experience a few negative month returns. So you can see that 5-year rolling average mean reverting to that long-term number. But where to from here? Hard landing, soft landing, strong recovery. I don't think many investors or market commentators are talking about strong recovery, but I do hear a lot of people talking about soft landing. Just want to highlight one more thing, and it feels like I'm showing you a lot of these anomalies, and this is another one where historically, over the last 20 years, bonds provided safety, right? Equity markets correct, bonds go up, right? Now, every time you see equity markets correct, you see bonds go down, right? That correlation, right now, is this the new normal? Was the last 20 years abnormal, right? So the strategy that we were used to bull for in the past, we may have to have a different strategy going forward. And bonds, historically, were your low volatile portion of that portfolio. Now that they have a higher correlation with equities and they're even more volatile, they will swing your whole portfolio around. So let's put it all together. Now, I'm going to go talk about the strategies involved in terms of the accumulation phase and the retirement phase, and also talk about some of the issues with them as well. So it's pretty simple for accumulators. If you're 25 years old, 35 years old, find investments where they can maximize the returns. It's all about growing the nest egg. They can survive 1 or 2 GFCs. Those GFC events, they just put more money in the market because they're still working and just ride up the wave whenever that bear market ends, right? With retirees, it's a bit different. You've already spent 40 years building that nest egg. So the trick is to not blow it, right? Managing sequencing risk is extremely important, right? Now, managing risk doesn't mean we're not focused on total return, right? But we're not there to maximize returns. It's there to provide a reasonable return outcome, but to manage sequencing risk. So very different objectives, very unique objectives in terms of that retirement phase. Now, the first problem with these plans is that, yes, I know most people understand these plans, but the problems come because we end up being complacent, right? This is the first problem. Complacency can lead to failure, right? So when you think about equities, what about those times when sequencing risk was very low? The frequency of down months was very low. How easy is it for us to go, oh gosh, a fund manager did 30%, but this one did 10, right? Maybe I'll just allocate more to the guy who just did 30%, right? That typically creeps into someone's portfolio when everything looks rosy, when managers are, some managers are hitting, numbers that's way out of the ballpark, right? Have we left that type of portfolio the same through time, right? If you're chasing the returns, I hope you've taken a lot of money off the table because the bad times do occur, right? So, as we've seen historically in the past, it can potentially go from one extreme to another. And from a fixed interest point of view, right now everything looks rosy for fixed interest, but is now a great time to invest in fixed interest when everything looks so good. So you might tell me that, look, Jason, 2/3 of the time the market's rising, right? So I'm happy to take on that risk, right? But you're now taking on 30%, right? And you're rolling the dice within that retirement risk zone, right? And we know that's a long-term average. What if it spikes to 40%, in terms of negative months, or 50, like during the GFC? You're really rolling the dice, right, if that occurs within that retirement risk zone. That 25-year period where that nest egg is at its largest, right, it's all about making sure that lasts as long as possible, right? And if that's not managed well, right, obviously the number of years gets reduced in terms of how long that nest egg can last. The other issue I want to raise associated with creating portfolios is the core satellite approach. Now, Vanguard and the passive funds in the industry have done a wonderful job educating everybody to have a core satellite. And to a large degree, I agree with them, right? Because their message is that 80% of the time, active fund managers underperform over the long term. I agree. Those are very strong stats. Very hard to argue against that. So their message is, have a passive fund as your core allocation. If you do find a fund manager that you like, you can put them in as a satellite. Maybe if you like them a little bit more, you add a little bit more, right, to the allocation. And of course, the objective there in the accumulation phase is grow that nest egg. It's all about returns. What the passive industry has not highlighted, they're actually very silent in terms of retirement portfolios, right? Should you have an index fund as core in a retirement portfolio? Now, if markets always go up, why not? There's no risk. That type of thinking comes in strong bull markets. That's when complacency sets in, right? So remember, these equities markets can be extremely volatile, right? Historically, you could have added a bond portfolio to offset that risk and have the counterbalance every time equity markets correct, bond portfolios go up. But what if that correlation today is closer to 1, right? The bonds are not going to do the heavy lifting under that type of scenario. Having an index fund as core, having a bond portfolio, that portfolio is going to swing around as soon as we see a few negative returns. Right? So in that retirement phase, you really have to reverse that core satellite approach. Right? So the core should be finding a strategy that can deliver a similar return profile, let's say to a passive fund, that can control that risk profile back. Right? There's nothing wrong for an active fund manager to actually give a similar return, but if that risk profile is dialed back, that will do wonders to that to the duration of that nest egg, and that will last longer. So I'm going to finish off on one of my favorite charts, right? So in terms of why I like it so much, right? Because over the long term, the capital values associated with Aussie equities do grow, right? As it's growing, it does deliver 4 to 5% income return, which is obviously very helpful for retirement portfolios. So how does Vertium sort of fit into the picture, right, on this Aussie equity space? So we provide a 6% income return, right? Obviously a significant premium in terms of what the market offers, right? And in terms of equities, the volatility involved, you may have clients go, geez, I'm just not sure. Because look at it. I mean, the GFC event was terrible. You know, right now, the last couple of months, you look at the equity markets, it is wobbling a little bit. Who knows what next year is going to bring? But in terms of what we do, we actually remove about 30 to 40% of the volatility from our equity market exposure. Right. So hence, we pretty much provide equity-like returns, but with an insurance policy associated with volatility. Right. So we keep clients invested longer and to stay in the game, right, and grow that capital base, and obviously generate a lot of income along the way. Right. So thank you very much.
There were some really interesting points that you were making there that highlight to us some of the challenges that we're facing. And I think one of them, I mean, you might be able to help. When a client sits in front of us and says, look, really for where we are now, I can get 5% in a term deposit. I do understand that in the long term, by owning things, I'm going to do better. But for now, why don't I just sit in a term deposit for the next 12 months and we'll revisit that conundrum in 12 months' time and I'll buy into the market then? How would you respond to that sort of?
Yeah, so that's a question on market timing, right? Market timing, you just got to be really good at it, right? So I don't know anybody who's fantastic at doing that. Like just trying to buy the bottom during the global financial crisis, it was very difficult. You know, alternatively, like I said, keep your clients invested, and hopefully with us, right? We can take a lot of that volatility out, and we may not have a hard landing, but there'll be lots of opportunities for us, for example, to take advantage of, right? There'll be a few stocks that'll be falling out of bed, and I guess based on our risk-return framework, we can then, you know, allocate capital right then and there, as opposed to clients trying to time the market.
I think that's a very valid comment. I think one of the other issues for them is that they forget that markets are forward-looking. And you may well be in a position 12 months from now and go, well, look, I'm comfortable to buy now, but you probably, if you're that comfortable, you're buying in at higher rates.
Yes.
And so you've just increased your entry point significantly. I think the other point that I'd like to maybe flesh out a little bit more is the issue when you took us back to 89, because it was only in the last few days on our investment committee, we were actually just looking at the US 10-year return, 10-year bond return, versus the return from US equities. And whereas, you know, for some time we've seen about a 2% differential, so you can make 2% more from the profits available to you through companies, whether or not they're using share buyback or dividend, versus what you could make on a government 10-year bond. In this short period of time, they've now equalised. So, you know, can you just revisit that comment that you were making about 89 when you could make 16% on a term deposit? I've still got in my cupboard, I worked for a credit union back then, the old Outlook Credit Union, Ansett employees, and I actually have a poster showing a 3-month term deposit rate at 18%. I think that was about the peak. But I thought your comment was interesting about what happened in the following years. I just thought I'd like to get you to re-emphasise that.
Yeah, so look, I actually highlight that point for a good reason, right? Because I'm trying to highlight, from an income perspective, what's the worst point in history to compare, right? How do you wean off a client off a 16% term deposit rate and stay invested for the 30-year plan? Right? Now, when people talk about term deposits, like, oh, let's try to time it, they're only thinking 1 year out, right? But are you structuring retirement portfolios for 1 year or for the next 30 years, right? So, and if it's a 30-year plan, yes, there'll be a cash element part of the total portfolio, right? But if you want that income growth profile, even at the worst point in history, equities over that 30-year journey, especially Aussie equities, still gave you their income, but gave you a growing income profile as well, with a growing capital base.
Final question at this point, Jason, was we're seeing the reporting season from the US market coming through, and again, surprisingly good results. So many companies reporting positive, but bankruptcy at the same time increasing. The signals seem so mixed at this point in time, which leaves us all. Because, I mean, one of the biggest jobs we've got to do is educate our clients.
Yes.
I mean, one of the analogies I've always used, I always see myself as a glorified roller coaster attendant. You know, I really only have two jobs. One is to make sure they get on the right roller coaster, but this is the hard bit, getting them to remain seated for the duration of the ride. So, you know, when you look forward from this point, how would you be educating clients about this uncertain environment and what to expect?
Yeah, it does seem very uncertain. Like, that's why I show these charts to highlight there's a lot of anomalies out there, right? How do you reconcile the fact that corporates, listed corporates, are reporting good numbers, but then you see bankruptcies rising? So obviously, it's a segmented market, right? So bankruptcies typically occur for smaller companies, right? But they're the ones that, you know, effectively they're the canary in the coal mine, right? Because they're the ones that get hit first, right? So it's obviously rising, but the results that we see in the S&P 500, well, because they're the big companies, right? Generally, they're doing okay, right? You know, but they could be, like I said, with them being the canary in the coal mine, there could be a sign for things to come, right? So the underlying economic uncertainty in America is actually very high at the moment. Yeah, sure, Microsoft, Amazon's doing fine, you know, but what about the rest of the economy, right? So, you know, it's something that we're watchful on in terms of how things could transpire, and obviously, you know, allocate our portfolio appropriately for this type of environment.
Ladies and gentlemen, can I get you to thank Jason for an excellent discussion? Thank you.